Okay, so there was pretty big news in private equity this week. Publicly traded Apollo, the large private equity firm that has diversified into multiple asset classes within asset management, purchased Bridge Investment Group, which is a real estate specialist, really known for their asset management capabilities. They're very good at fundraising, but have run into some issues because of the real estate downturn, interest rates being high. Just want to share my high level thoughts on why this transaction happened and what its implications are for private equity and the GP stakes investing world. All right, so this transaction was $1.5 billion dollars for about 50 billion dollars in assets under management. And on a fee related earnings multiple, FRE multiple, this was around 11 times earnings. And 11 times FRE is pretty cheap in this space compared to the larger players that are more diversified and aren't facing as many headwinds. They're trading in the high 20s to sometimes up to 40 times FRE, fee related earnings, once again. So this was a great purchase price for Apollo. Number two, they paid in stock. They didn't come up with the cash. They basically issued a piece of paper to Bridge for 10,000 shares of Apollo trading at 150. There's your 1.5 billion. And when you think about it, they created money out of thin air. Apollo is trading at a nosebleed multiple compared to Bridge. Now think about that for a little bit. Now, whether or not this 43 is exactly accurate, I saw estimates from 36 to 43. It's still a multiple of what they're paying for Bridge on their fee-related earnings. And so the way Apollo looked at this transaction is that in addition to all the nice benefits we talked about in the overlap of the two teams, the new asset management capabilities and fundraising benefits, they're taking 137 million of fee earnings and they're going to port it over here under the Apollo umbrella. So now this goes up. And that money, instead of sitting in here languishing at 11 multiple, it's now over here at a much, much higher multiple. So that money is not going to be apples to apples because, once again, it's in real estate versus extremely diversified. But if it was, they're porting that money over and now they're getting a similar multiple on that 137 million. If those earnings were truly comparable, they were the exact same, they didn't spend a nickel on this transaction from the accretion standpoint of that larger multiple. I think this was a hell of a deal for Apollo. Frankly, it's a good deal for Bridge too, because I think that they've now joined a winning team. They can leverage their capabilities in asset management and real estate, which Apollo really needs. Apollo doesn't have a giant real estate team. They're not really known for their real estate capabilities. It's not as old as their credit or the private equity divisions. And so this transaction made a lot of sense, not just from the purchase price, but also from a strategic standpoint for Apollo. And you could see how it makes sense when you're comparing Apollo's capabilities in real estate in green here versus Bridge's capabilities and expertise in real estate. By sector, there's not a ton of overlap. These pieces actually fit together like a puzzle. And so I think that Apollo is going to be in a very good position to pursue even more real estate AUM, infrastructure, real assets, and is going to be able to leverage this team, which frankly is also extremely good at fundraising. Here is their history of fundraising. They have really exploded in growth from an AUM standpoint. Bridge has gone from 5 billion to 50 billion in 10 years. That's amazing growth. And I assure you, Apollo is going to take the best people in the fundraising division that Bridge has. They're going to unleash them into Apollo's limited partners. And then also Bridge, those people are going to introduce Apollo to their limited partners within real estate. So it's easy to see how the pie can get a lot bigger from here. It's not just going to be this $1.5 billion transaction. For the Bridge partners, they are highly likely to make a lot more money by tapping into Apollo's network, tapping into their acquisition team, growing the pie. In theory, the partners at Bridge are probably going to make a lot more money over the next 10 years with Apollo, with this quote championship team, than they would slogging it out, trying to work out some of the real estate problems that they had in their current portfolio. I know they recently launched a couple of office funds that are clearly having problems. So rather than focusing on those headwinds, I think they're going to be able to go back on offense with Apollo having their back, leveraging Apollo's team. It's a different message to limited partners. It's about the future. It's not about the last fund that had some problems with office. And so you can see how that story is going to play a little bit better with limited partners, endowments, pension funds, RIAs, I think both sides are actually benefiting from this. But in my mind, the main point here for me from a GP stakes investor is just thinking about how a specialist private equity firm is not particularly suited for the public markets. And this is especially true with a real estate firm, which you can think about real estate, it's a cyclical business. And everybody forgets this. 7 to 10 years, there's a new crash, there's a new credit crisis. People got way over their skis on leverage. Pricing got out of hand because it was tied to low interest rates. This happens like clockwork. And that is something that Wall Street hates. When there is a downturn or headwinds like there are now for real estate, Wall Street's not going to care about how you're solving this problem. You're going to fix it in 3 years. These analysts are not going to give you the time. These trading firms don't have the patience anymore to think long term. Everybody's thinking this quarter. So you can see Bridge Investment Holdings here has had a rough go from a stock standpoint ever since their IPO. The partners have seen their net worth slowly decline here. And when your stock is publicly traded, that leaves you vulnerable to other firms that are looking at you and say, hey, that looks pretty cheap, and maybe we should make an offer. And when you're publicly traded and you get letters, you get calls, and you have a board, you have a fiduciary responsibility to the shareholders to entertain purchases. Whereas a private company, you can just tear up any offer that you can get. You can say, go pound sand. I don't know how this went down. I do know that 11 times FRE seems cheap to me. I think that if they had stayed private, Bridge probably could have focused on some of their higher performing asset classes or segments. They probably could have made a few cuts, get out of office. That didn't go too well because their long-term track record was solid. And clearly they are very good at fundraising. So whenever we come out of this real estate downturn and people are more willing to put money to work in real estate, Bridge could have weathered the storm. In fact, they probably could have bought themselves some more time and really focused on growth again by bringing in a minority partner, taking the GP stake up to 20% of the firm. They would have maintained full control of their future. Whereas now, of course, Apollo is the captain. They are going along for the ride. So my takeaways from this transaction, when you think about it from a GP stakes investing lens, which is what I ultimately care about here, is a couple of things. How important it is for a general partnership to diversify their revenue streams, their fee streams, to not just be one asset class. And that's if you want to go public. I love specialist private equity firms that stay small, have a great thesis, a nimble team that are just going to attack one sector and become the best of the best at that strategy. The problem is, once again, when you go public, then you're trying to solve a different problem. You're not trying to just drive great total returns. You're trying to be predictable for Wall Street. And when an outlier happens like COVID or giant inflation, your sector is getting pounded. It's an existential threat to the business. This also, frankly, is a positive sign for GP stakes from an exit liquidity standpoint. It's nice to see that even an asset management firm that is going through a challenging time can still get an exit cheap compared to the publicly traded multiples, but not cheap compared to what minority positions trade for from a multiple standpoint. This highlights another interesting point within GP stakes investing. A lot of people get concerned about where is the exit going to come from, even though these are meant to be extremely long-term holds. They're fantastic businesses. Normally you don't want to sell. But if you need an exit, you can see the publicly traded firms, when their multiples are high, they are extremely incentivized to do an acquisition, to bring in new assets under management. They don't have to spend 10 years in Delta Sky Clubs, flying all over the country, flying all over the world rather, with their hat in hand, looking for more money. If they could just, in one transaction, scoop up 50 billion, a brand new asset management team to play with, to go make more investments in real estate, to grow their infrastructure business, that moves the needle a lot faster on their path to $1 trillion in AUM than going to try to do that organically in a fairly small segment for them. They just doubled their capabilities and their AUM in real estate like that. And that feels like there's a floating bid out there. If you want to sell your private asset management firm, your private equity firm, to a publicly traded company that's trading at a nosebleed multiple compared to what you could sell a stake for, you could see how there's likely liquidity. It's hard to raise $50 billion. It's much easier to get that done over a few months and a bunch of paperwork and lawyers. Okay, hopefully that was useful to think about how a publicly traded private equity firm, how they can use their stock as a weapon for M&A. And hopefully it was also useful in thinking about GP stakes investing and why some of these things matter in terms of being a segmented player and staying private versus wanting to be very broad and diversified as you're a publicly traded general partnership. All right. Thanks, everybody.